Welcome to Explain the Charts. Today we are taking an in-depth look at the USD-CAD pair on this Monday morning, March 16, 2026. The current global landscape is dominated by the escalating conflict in Iran, which has fundamentally shifted market sentiment toward a defensive posture. Geopolitical tensions are providing massive support to the US dollar as a safe haven asset while global investors flee riskier positions. Meanwhile, the Canadian economy is facing significant internal pressure after a disastrous labor market report showed over 80,000 job losses in February. This divergence between a strengthening greenback and a weakening loonie is the primary driver behind the recent bullish momentum in the pair. Energy markets are also in focus, with WTI crude oil retreating slightly from the $100 psychological level but remaining highly volatile. Analysts are closely watching the Bank of Canada and the Federal Reserve, as policy divergence seems to be widening given the current economic data. The market is currently pricing in a more aggressive easing cycle for Canada compared to the United States. This fundamental backdrop creates a complex environment for traders where technical levels must be respected against a backdrop of news-driven spikes. We are currently seeing the pair trade near the 1.3719 mark, up from the previous close as volatility remains elevated. Transportation costs and inflation fears are rising globally, further complicating the outlook for the Canadian dollar. Central bank intervention is a potential risk to watch, particularly if the currency volatility becomes unmanageable for regional economies. Despite oil's elevation, the safe haven flows into the USD are currently the dominant force on the daily time frame. Traders should remain cautious as sudden headlines regarding the Iran conflict can cause immediate and sharp reversals in either direction. Now, let's dive into the price action to see how these events are manifesting on our actual chart data. Starting with the daily chart, we can observe a very interesting recovery trend that began earlier this year. After testing a multi-month floor near the 1.3500 level back in late January, the pair has been on a steady climb. This 1.3500 area has proven to be a critical support zone that buyers have defended multiple times throughout the quarter. Looking back at early 2025, the pair was trading significantly higher near 1.44, suggesting a broader long-term downtrend may be trying to find a reversal point. The current price action is testing the upper limits of its recent range, specifically eyeing the 1.3730 resistance mentioned in recent reports. If the daily candle closes convincingly above this 1.3730 mark, it would signal a technical breakout with the potential to reach 1.3850. However, we must note the historical resistance near 1.3900, which capped gains several times in late 2024. The daily candles show a cluster of activity around 1.3710, indicating that the market is searching for a catalyst for the next leg higher. Volume has remained consistent during this ascent, which provides some validity to the current bullish trend. We also need to keep an eye on the moving averages, as the price is currently trading well above its short-term historical means. A reversal here would likely seek support first at the 1.3650 level before retesting the stronger 1.3580 zone. The daily time frame suggests that as long as geopolitical risks remain high, the bias for USD-CAD will lean toward the upside. Wait-and-see sentiment is prevalent among institutional traders who are waiting for more clarity on US PCE data and upcoming Fed meetings. The correlation between oil's retreat from $100 and the USD-CAD climb is clearly visible in the mid-March candle structures. Let's zoom in further to see the intraday behavior that led us to this specific price point. On the 1-hour chart, specifically looking at the range between late February and early March, we see a defined consolidation phase. Notice how the pair spent significant time chopping between 1.3660 and 1.3710, building the liquidity needed for the current move. During this period, every dip toward 1.3670 was met with aggressive buying, highlighting a strong intraday support floor. This consolidation was a precursor to the volatility we are seeing today as news from the Middle East began to hit the wires. We can see a trend-like move starting near 1.3575 that extended to session highs near 1.3715. The technical breakdown that some analysts feared earlier in March seems to have been neutralized by the safe haven bid. Looking at these hourly candles, the VWAP levels are consistently being tested and used as launching points for the next candle. Traders should look for hourly closes above 1.3720 to confirm that the bullish momentum is sustainable for a swing trade. A failure to hold 1.3700 on an hourly basis would likely signal a fakeout, leading to a quick retracement toward the 1.3680 support. The volatility bands are widening here, which suggests that the market is preparing for another significant expansion in price. Pay close attention to the transactions and volume spikes during the early Asian and European trading hours. The hourly trend currently shows a series of higher lows, which is a classic bullish indicator in this time frame. Resistance is becoming more defined at 1.3725, which has capped the most recent 3 hourly attempts. If you are trading on this time frame, watching the reaction at 1.3710 is crucial for determining immediate market direction. We are seeing a lot of indecision candles, known as dojis, appearing near the current resistance, suggesting a battle between bulls and bears. Moving to the 15-minute chart, we can see the micro movements from the last 48 hours leading up to today, March 16th. There is a very clear consolidation around the 1.3715 level, with the pair trading in a very tight 20-pip range. This type of tight trading usually precedes a breakout, and given the current news, the risk is skewed toward the upside. The support at 1.3708 is holding remarkably well, acting as a trampoline for any minor sell-offs. Looking at the individual 15-minute candles, the wicks on the bottom side suggest that there is a lot of hidden buying pressure. If the price breaks below 1.3705, the next level to watch for a scalp long would be the 1.3690 area. On the flip side, a sudden move above 1.3725 would likely trigger stop losses for short sellers, fueling a rapid spike. The VWAP on this time frame is currently sitting right at 1.3714, which is where the price is gravitating toward. This suggests that the market is in a state of equilibrium, waiting for the next headline regarding Iran or the U.S. economy. The 1.3719 high from earlier today is the immediate resistance level for intraday traders to overcome. Notice the lack of significant volume during the late Sunday session, which is typical before the Monday morning volatility kicks in. Now that the Monday session is in full swing, we expect volume to pick up significantly at these key levels. I would suggest looking for a retest and hold pattern on the 1.3710 support before entering any new long positions. Alternatively, if the price aggressively rejects 1.3730, a short-term bearish reversal to 1.3650 becomes a high-probability scenario. This time frame is perfect for identifying the exact entry points once the larger daily trend is established. To recap our analysis, the most important price levels to watch for USD CAD are 1.3730 and 1.3500. I believe there is a 70% likelihood of testing the 1.3800 level this week if Middle East tensions continue to escalate. This prediction is reinforced by the safe haven demand for the US dollar and the weak Canadian jobs data. Conversely, there is a 30% chance of a reversal back to 1.3550 if oil prices surge back above $105 and geopolitical news cools down. Watch for a daily close above 1.3730 as a major confirmation of the bullish continuation. If the pair fails to break 1.3730 and closes below 1.3650, the bullish thesis for the short term will be invalidated. Keep a close eye on the US PCE data and the upcoming central bank meetings, as these will provide the long-term direction. Remember that in this environment, technical indicators can often be secondary to fundamental news breaks. Always use proper risk management and stop losses, especially when trading during active geopolitical conflicts. Support levels at 1.3706 and 1.3650 should be your primary areas to look for by entries on retracements. Resistance levels at 1.3730 and 1.3850 are your primary targets for profit taking on long positions. The divergence between the Fed and BC is the long-term theme that will likely keep the pair elevated through mid-2026. Thank you for watching Explain the Charts, and be sure to subscribe for more in-depth market breakdowns. This video is for educational purposes only and does not constitute financial advice. Always conduct your own thorough research and consult with a professional before making investment decisions.